What we're going to do now is talk about the different patterns or varieties of divergence and what their implications are for subsequent price action. Now, there are two basic categories of divergence, and within each of those two categories, there's two further types. There's 4 divergence patterns that we work with all together, and they each have their own names and so forth, but it can be very confusing, especially at the outset, to keep these different patterns straight in your mind, what they look like, what they mean. And so what we're going to do is start off trying to conceive of these different patterns with a very simplistic kind of conceptual framework so that they're easier to work with. So when we're connecting bottoms on price and MACD, what we're looking for is positive divergence. Regardless which direction those support lines are heading, whether up or down, we can think of the support lines as inherently bullish. Okay, so draw that connection in your mind between bullish support and higher prices to come. This is what positive divergence ultimately signals. Now, there are 2 types of positive divergence based on the trendline direction. There's standard positive divergence, which sees a falling support line on price. This is the slope of the line that we would draw connecting bottoms on price, matching up with a rising support line on MACD. So the 2 lines are heading in opposite direction, but as long as they're connecting tops, it still means the likelihood of price to rise further from there. Inverted positive divergence is the opposite. We have a rising support line on price, which would connect the bottoms from below, and then we have a falling support line on MACD, this red line connecting lower lows on MACD. So you can see that these lines are heading in opposite directions, and if you want to, you can just memorize these patterns and assign a label to it. But again, the most important aspect of getting positive divergence straight in your mind is that all we're looking to do is draw lines underneath lows, and to see those lines on price and MACD heading in opposite directions. That's all you really need to remember. When you see those lines connecting lows, going different directions, that is positive divergence. And it doesn't even really matter whether you're dealing with standard or inverted. It still has the same implication. So think of those support lines as inherently bullish when they're trending in opposite directions. Let's look at a couple of real-life chart examples that demonstrate this principle now. Here is an example of standard positive divergence. So as per usual, what we do is we start off step 1, we look for swing points on MACD, and we can see a couple right here. We have a swing low here, and it's preceded by a lower low on MACD. So we go ahead and draw a line that simply connects those two. You don't even have to worry about drawing them directly underneath. Just a line that slopes up somewhere in the vicinity here to mark it on your chart. Then we see, incidentally, we have some nice swing points on the histogram as well, which are moving in the same way as MACD. So we take a line and we draw the 2 swing lows, a low preceded by a lower low. Then we shift our attention up to the price panel, and we have a couple of really nice clear swing points that just stand right out. So the first swing point being here, we look backwards and we see another swing point here, a higher low. We connect those with a falling support line. Okay? Again, the point being we have support lines. Doesn't matter which direction they're headed respectively. It's just that these are support lines. We draw the connection in our mind. Support equals bullish when we're drawing divergence. And so the implication is we're expecting prices to rise. The inciting incident after this divergence signal is a trend line break right here, and we can see what happened subsequently. Price broke the trend line after the divergence signal. Positive divergence, rising prices, and that's exactly what happened. The market rose after this divergence signal. Let's look at an example of inverted positive divergence next. All right, this is the other way we can draw positive divergence. We start off by looking for swing points. We're hunting for swing points on MACD. We find a swing low here, and we're looking back in the background to see if there's another swing point. We're not concerned whether it's higher or lower. We're just looking for a swing point to see if we can draw a line connecting them. And yes, indeed, we do. So we take and we draw a sloping line that demonstrates a low preceded by a slightly higher low. And incidentally, I could have done the same thing under the histogram here. I didn't draw that, but you can see just by eyeballing it, we had a low on the histogram preceded by a higher low, which provided actually a little extra clarity to the line that I did draw. Okay, so then again, what we do is we switch our attention to the price panel and we look for swing points. This is another example of where it's interpretive liberty. We're not seeing real crystal clear swing points, but more or less we have one around here and we have one around here, and they both outline rising prices. So we draw a trend line, a rising support line underneath price. We compare and contrast and see these two lines, three if I'd drawn one in under the histogram, they're moving in different directions. We're not going to stress out about, gee, is this inverted or standard, which way is which line supposed to go. It doesn't really matter. It's just the fact that this is a support line and this is a support line and they're heading in opposite directions. The implication is bullish. Support equals bullish when we're drawing divergence lines. Now, unfortunately, this chart doesn't do a very good example showing you the impact because I had to blow it up a little bit for clarity. But what we would be looking for after this point is for a trigger to get us in on the long side, and that would come in the form of a trend line break happening off to the right-hand side here, which unfortunately I just couldn't fit in on this chart. So once price breaks this trend line, with this bullish divergence signal in the background, you'll want to grab a long position on that trade. So that's what inverted positive divergence looks like. Let's do the rundown now for the other type of divergence, which is negative divergence, which is inherently bearish. So again, what we're going to do is conceive of this really simply to keep it straight in our mind and not have to worry about all the labels and things. So what we're doing when we're looking for negative divergence, we're connecting tops on both price and MACD. When we connect tops from above, regardless of which way the line is sloping, it's a resistance line. So again, we're conceiving of this very simply. We're drawing the connection in our mind that a resistance line is inherently bearish. Bearish meaning we're expecting lower prices to come after the signal. So the same way we had both standard and inverted divergences in the case of positive, we have both types for negative divergence as well. So standard negative divergence, what we have is a line that connects higher highs on price, a rising resistance line, and on MACD we have a line connecting lower highs. Okay, so these lines are obviously heading in opposite directions. That's divergence, and if we're connecting tops from above, that's standard negative divergence. The inverted flavor of negative divergence is just the same idea, but just inverting where the lines are happening. So for example, price will see lower highs here, whereas MACD is putting in higher highs. We're drawing lines connecting those highs from above, and we're seeing that they're going in opposite directions. One is pointing down, the other is pointing up, and vice versa. So again, we don't have to stress out about which label goes with which pattern. All we have to remember is that when we're connecting tops from above, that gives us some type of resistance line, and we're just making that simple connection. Resistance equals bearish equals lower prices to come. So I'll show you two chart examples of these different patterns now. Alright, so we're going to look for a standard negative divergence, and we have the process committed to memory by now. We're looking for a couple of swing points on MACD to see if we can join them, and yes indeed we have a swing high on MACD here above the waterline, and what we can do is look back and see a higher high. We connect those tops from above with this down sloping or falling resistance line. We look up at price, and what do we see? Who dad? We got a really nice clear swing point on price here, and we look back to the past and see a lower high swing point in the background. We connect those two lines from above with a rising resistance line. These two trend lines on the two panels are going in opposite direction. Again, we draw that very clear connection in our mind. Resistance equals falling prices. And the inciting event, or one of them that we can use, is this trendline break to get us into the short side. And you can see what happened. Price subsequently tumbled very nicely. We're going to look at some specific trading strategies to use with divergence, but trendline breaks are obviously always really nice. And this example just demonstrates very well the power of divergence signals. When we got this clear upthrust swing point here, that was a really good fake out signal. Actually, what the market was trying to do was fool everybody into going long, and as soon as they did, a number of stops were triggered. Price was marked right back down. There's no momentum to the upside here. This is what this falling pattern on MACD is conveying. There's just no upside momentum. This is not real price action. This is very temporary. And when we broke the trend line, that negative divergence signal gave us a really good signal to go short. Going to look now at an example of inverted negative divergence. As per usual practice, we're hunting for some swing points on MACD. We find a swing point high here, and we see there's a lower high in the background. We connect those two tops from above with a rising resistance line. Now, at this point, you could jump in and object, well, hey, hold on here just a second. The histogram is doing something entirely different. We have a swing high connecting to a higher high in the background, so it's a line sloping in the opposite direction. Wouldn't that have very different implications? And the answer is yes, potentially. I don't know what the textbooks say about this, but the attitude I always take is that if you have a potential divergence reading on MACD relative to price, MACD carries the day. We're going to ignore what the histogram is doing in favor of MACD, MACD being the more important signal that we're looking for. I don't know if that's textbook theory or not, but it's a trading style and it seems to work. So we have a rising resistance line on MACD. We're going to just ignore the histogram in this particular case since it's giving us some disagreement, because concurrent with this trend line on MACD, we have a swing high on price, and that connects back to a higher high in the background, and we connect that with a falling resistance line. So again, drawing that very simple connotation in our mind, a pair of resistance lines, resistance being bearish if they're heading in opposite directions. And so what we're looking for is lower prices, and the entry signal on the short side in this case being a nice demand trendline break, and we could follow that down. We see how that price went this far and indeed further. And in fact, that trendline break was validated by a bearish crossover on MACD. So that's what inverted negative divergence looks like. Again, if you happen to run into the scenario where MACD and the histogram are at odds, always side with MACD. It's going to tend to give you the more accurate reading, particularly when it does outline a divergence relative to price. Sometimes you're going to see a divergence setup that doesn't give you anything at all. Okay, and you might be scratching your head wondering, well, what the heck? This is supposed to be such a great thing. How come it didn't do what it was supposed to do? Well, you always have to consider trend. Okay, it's the same old mantra over and over again, because if you get a negative divergence signal coming in the midst of a strongly uptrending market, it's going to have far less effect than a positive divergence in an uptrending market, and vice versa, okay? Because negative divergence is giving us a counter trend or contrarian signal if the market is trending up, and similarly positive divergence gives us a counter trending signal if the market is trending down. So what can you do to kind of validate the setup, if you will? Well, one thing you can do is you can consult the trend indicators on whatever time frame the divergence signal happens. So, for example, look at your 200-period exponential moving average. Is it trending strongly up in a positive sloping direction? If so, there's an increased chance that a negative divergence signal in that uptrending market is not going to be reliable. Look at trend indicators on the next higher time frame. We looked at that concept in Module 3, putting trend indicators on two time frames next to each other. Look at the oscillators on a lower level. If you've got a positive divergence signal, but your oscillators are all severely overbought on that lower time frame, now certainly is not the time to go long, and it might actually end up invalidating the setup. Similarly, don't go short a negative divergence signal if your oscillators are all extremely oversold at that point. You might want to just wait it out and see if the setup is still valid. So in a nutshell, we have to consider trend when we're looking at divergence signals. If you have a trending market, you'll want to take a divergence signal that lines up. The same way that we want to establish a bias before we draw a trend line break, we want to establish a bias before we consider jumping on a divergence signal. So that's why sometimes divergence signals don't work. If they're counter trend, they're much less reliable than if they're on trend or if the market is not actually trending at that point. Here's a chart example that really demonstrates this principle quite well, I think. We're going to find a couple of swing points on MACD. We have a swing high preceded by a higher high. We go ahead and draw that trend line connecting the tops from above. And we're going to look at what's happening on price. We've got some swing points, a swing high preceded by a lower high, and that gives us a rising resistance line. Resistance equals bearish when we're drawing divergence if the two lines are heading in opposite directions. So we see that and we get all excited. We're going, aha, negative divergence. Let's go for it. Well, let's take a look at what happened subsequently. Price really didn't do much. I don't remember what particular time frame this chart was, so whether each of these individual bars was a lot of pips or not. Regardless, in relative terms, you can see that after this negative divergence signal, price just sort of went a little bit sideways before it continued on up. So what's going on in this chart example? Well, we can see this gold-colored 200 period moving average. It's moving at what looks to be like about a 30-degree angle. In any event, it's very clearly uptrending. The red 100 period moving average, strong angle and separation, trending up. The guppy group of slow moving averages, these blue lines, they start to get a little bit squishier here, but they all remain above the 100 period moving average. A little bit of angle and separation. They're certainly not curling over each other. And the orange fast group of moving averages, they don't penetrate the blue lines and trend down. They just get sort of squishy and constricted, indicating actually compressed volatility. And if you see that happening in an uptrending market, well, it's going to break out sooner or later. Which way would you assume? Well, if the trend is up like this, I would expect these guys to break out to the upside, and that's exactly what they did. So here's an example where we got a negative divergence pattern, but because it was a strongly uptrending market, it had little or no effect. Okay, it would have been far better to find a positive divergence of some kind. And I don't actually see one here. But there are other ways, of course, we could have traded this trending market. In this event, trend trumped divergence, and it wasn't useful for us. So always keep those trending indicators in mind when you're looking at these patterns. And don't even bother drawing them if they're counter trend. It's just not worth your time.